What's up, everybody? Welcome back to the stocktrades.ca YouTube channel. My name is Dan Kent, one of the co-founders of stocktrades.ca and one of the partners over at Stock Trades Premium, our leading investment platform for Canadian specific stocks. If you're interested in that, head down to the description. It will be the first link you see. In this video, we're going to take a turn from what we generally speak on, which is Canadian specific investment research. And instead, I'm going to speak on a specific investment strategy that has helped me, one that I've implemented ever since I started investing, and one that can significantly reduce your overall risk in this crazy and somewhat overvalued market. This is a strategy that is going to allow you to stop worrying about the current price of the market and instead invest without worry. And that strategy is the averaging strategy. There's two things that you need with this strategy. Obviously, you need money to invest, and secondly, you need something that the vast majority of retail investors do not have. And if you do have it, you're going to succeed in these markets, and that is patience. So, an averaging strategy. What exactly is an averaging strategy? Well, an averaging strategy essentially attempts to take advantage of price movements in the stock market, and instead you spread your purchase of a specific stock out over a predetermined period of time. And I can't stress enough how much I mean predetermined. An averaging strategy doesn't really work when you pick and choose when you're going to average. So let's take a quick example. We have $5,000 to invest in a specific stock. We could invest that $5,000 immediately today, but then we put our $5,000 at complete exposure to forward price movements. We're not all totally blind to this. Obviously, we realize that the stock market is overvalued right now. There's no denying that. But that doesn't mean that you shouldn't be investing in the stock market. And an averaging strategy can help you out immensely by taking your money and spreading it out. So if we purchase that $5,000 stock, we put all $5,000 into it, and the market crashes, by 20%, 30%, we're going to face the full brunt of that. But if we use an averaging strategy and say we spread that $5,000 out over the course of a couple months, 6 months, heck, even a year if you wanted to, depending on the amount of reduction you want to see in the overall volatility of that investment, this can save you a ton of money. And actually, as you'll see in the 2020 chart that I'm going to show in a bit here, it can actually end up with you making a bunch of money relative to purchasing a stock all at once. Now, a lot of you might be sitting there saying, Dan, there's been statistical studies done that state that investing a lump sum actually ends up outperforming a dollar cost averaging strategy. And this is true, but what I can say is these studies strip out the most influential factor in retail investors underperforming the markets and making life-changing mistakes with their portfolios, and that is the emotional aspects of it. Take two investors, a lump summer and a dollar cost averager. If they are absolutely abiding by their strategy and cannot deviate from it, yes, the lump sum investor over the long run will outperform. What is the chances that they make an emotional decision or a mistake versus the dollar cost averager? I'd say it is significantly higher. And I actually believe that this is even more important moving forward as more investors enter the market, and naturally more investors who haven't witnessed a correction or a stock market crash think that their overall risk tolerance is significantly higher than it actually is. So if you have a lump sum and are willing to invest and you are an absolute emotional rock, you know that there is next to no chance that you will make an emotional decision, then yes, lump sum investing might be for you. But the fact is, we are all prone to making emotional decisions, and I'm especially speaking to newer investors who just haven't witnessed the overall volatility of the markets in 2020. In fact, All they've seen is green, and they might be taking on way more risk than they're comfortable with without even knowing it. So a lot of people ask, when do I use an averaging strategy? And the answer is every single time I purchase a stock. I never purchase a lump sum. If I want to take a position, $5,000 in a company, I never purchase that all at once. Pre-COVID, pre these crazy market conditions, I would typically take, of that $5,000, I would take $2,500, invest it now, and then in a month or two, fill my position. And I would have a complete position for 5,000 shares. But after COVID hit, the crash in March of 2020, I started extending this out even more. Now, if I have a $5,000 cash balance and I want to take a position in a stock, I'll likely invest $1,000 a month over the course of 5 months. This strategy may not seem like it would have worked very well in 2020. I realize a ton of our watchers right now just started investing in 2020, specifically after the March crash. So an averaging strategy like this looks like you're burning money. All the market has done since then has gone up. So why would you not just take a full position in a stock right now? Why would you average it out over a lengthened period of time? And the one thing I'm going to tell you right now, if you did start in 2020, this is not how the market normally works. I mean, we see people making 30, 40% annualized returns. I've seen people on Twitter publishing they have made millions in the 2020 markets. It's not going to be like this moving forward. It's completely unreasonable to expect, even with the crash, we see the NASDAQ jumping, an absurd amount, even the S&P gaining 15%. These are abnormal returns in even normal conditions in terms of annualized returns in the markets. So if you're a new investor, you're not going to see results like this moving forward. It could be crazy again in 2021, but that makes it even more important to utilize an averaging strategy. So let's assume for this example, we have two investors. Investor A decides to take that whole $120,000 on January 1st, 2020 and invest it in a index fund tracking the TSX. Investor B, however, chooses to take a wiser approach and invest $12,000 every single month on the first of the month throughout the course of 2020, because as a lot of people were saying at the start of 2020 even, they feel that the markets are overvalued and we could be witnessing a correction coming up. So they take $12,000 on the 1st of January, invest it on the 1st of February, they add another $12,000 and so on and so forth. If we look at this chart of the TSX, we can see that over the course of 2020, the TSX gained 2.2%. So that person who invested $144,000 at the start of the year would have around $147,168 to finish the year for an overall return of 2.2%. And before we get into the returns of the averager, we have to consider one thing here. Their portfolio had a massive drawdown during the crash. In fact, at one point, they saw that $144,000 shrink to under $95,000. Let's say in this instance, both these investors are brand new. They haven't been in the markets very much, and they really don't understand how volatile they really can be. This type of drawdown, I think it was in like under 20 days. This can lead to you making life-changing errors in terms of sell-offs. So even though we're going to talk about total returns on these charts, the volatility, and it's something that I'm going to show you during the averaging chart and averaging returns, the volatility of investing in bulk is significantly higher. And as we can see right here, this investor would have taken a massive hit just a few short months after investing. If we move on to the investor who decided to take a more cautious approach to reduce their overall risk, we can see here that the overall returns on the TSX index for the year are 2.2%. But this investor who averaged in actually managed to beat the overall index returns by quite a significant margin. So overall, if they would have invested $12,000 at the start of the month, each and every month of 2020, they would end up with a total value of $160,200 at the end of the year. This works out to be an annualized return of over 11%. This is far better than the investor who bought in bulk at the start of the year. And in fact, if we look to the max drawdown of the portfolio during the crash, when the markets hit rock bottom, they only had $36,000 invested. So while the investor who invested in bulk was taking, a over $40,000 hit, the person who decided to average in was actually only witnessing a loss during that time of a little more than 5 figures. So not only did investor B outperform the markets and outperform investor A, they also reduced their overall risk and volatility significantly. So when should we be using an averaging strategy? The simple answer to that, and we got this question hundreds of times in 2020, is pretty much every single time you decide to make a purchase. The only thing that investors get confused about is you don't have to have all the capital available to you right now. If you have $1,200 to invest right now and you want to eventually own $2,400 of a specific stock, that $1,200 works out to be a perfect half position. You don't have to take that $1,200 and think that you have to average that in. You essentially need an end goal, an overall allocation to how much you feel a stock should make up of your portfolio. If you have a $100,000 portfolio and you want a stock to make up 5% of that, you should essentially plan to average into a $5,000 position. You essentially set a date that you're going to buy the first portion, and you set a date that you're going to buy the second portion. The most important thing, and I can't stress this enough, is that you don't cherry pick specific price points in the market. The thing about a dollar cost averaging strategy and an overall averaging strategy is the fact you are going to average up or down. It doesn't matter. But as soon as you start picking and choosing specific price points that you want to enter the market, you're no longer deploying a averaging strategy. You're simply trying to time the market. And as we've stated numerous times, this is absolutely impossible. Anybody who's told you they've been able to do this has simply gotten lucky. So if you have the intentions of purchasing the stock or index fund or ETF or whatever you're purchasing, and you decide you want to average into that position, pick a predetermined date that you're going to buy the stock, ETF, index fund, mutual fund, whatever it is, and stick to that date. If the market is up by 5% at that point, you buy it. If the market is down by 5%, you buy it. The point of an averaging strategy is to ignore all market activity and instead average your money in over the long term to reduce your volatility. If you decide you don't want to buy because the markets are up 5%, or you decide you don't want to buy because the markets are down 5%, you're turning a solid investment strategy simply into a guessing game. You don't know what's going to happen after the markets have gone up 5, down 5. Just average in at predetermined times. So the next major question we get is, how long should I extend my averaging period out? Should I go 1 month? Should I go 2 months, 6 months, a year like I showed in the example? And the ultimate answer to that is it all depends on you. For me, I've now lengthened out my averaging strategy considerably. When I look to take a position in a company, I'll now extend it at least 3-4 months, often taking quarter positions every month. So, quick example, if I had $4,000 right now, $1,000 a month would be appropriate for me, and I would eventually fill that position after 4 months. The fact is, though, the longer you do stretch your timeline out, the lower your overall volatility will be. You will be less prone to massive market swings. And keep in mind that this is market swings in either directions. You're going to feel bad when you're averaging in and the markets are going up, but you're also going to feel really great about averaging in when the markets are going down. This is again why I can't stress enough that you stick to predetermined timelines and not just trying to time the ebbs and flows of the market to get your money in. So overall, an averaging strategy, it's not an investment strategy that's going to skyrocket your returns and make you a ton of money, but it is an averaging strategy that moving forward is going to be able to lower your overall volatility and reduce your overall risk. I really hope you liked the video. It was meant to be somewhat of a detour from our Canadian specific stock research, and if you did like it, smash that like button, subscribe to the channel, and most importantly, let us know in the comments below. If you like videos like this, we'll continue to make videos like this, but we need to know. If nobody comments that they like this or the viewership is low, we're just going to stick to producing research videos, and people who do like these videos may miss out. So comment down below, let us know if you like it, and we'll see you next time.